Hi everybody, this is Hustle Hub. I'm Giacomo, and today I'm going to analyze Crowdstrike. This is one of the stocks that you asked me to analyze after what has happened about a week and a half ago. And today we're going to see how it could possibly affect Crowdstrike in the future, how it could affect its revenue, its free cash flow, and therefore the value per share. So before we get into the video of today, a few disclaimers. This is not financial advice, and the data that I've taken comes from the New York University and Seeking Alpha. You can get a discount on Seeking Alpha, link down below. And as a reference for the calculations that I've made, the estimates and the projections, I've taken as a reference on an article from the guys from CRWD. They are two guys, Jordan and Simon, that do a phenomenal job in explaining and analyzing cybersecurity stocks, especially Jordan. He has a really good understanding of the underlying technology, so he can explain very well how the underlying technology works. And also he's a CFA charter holder, so he knows his stuff when it comes to financial analysis and so on. So if you want to know more about the technicalities of the error that CrowdStrike had, I will link their article in the description so that you can see exactly what has happened and understand it by yourself. Today I'm going to stick just to the financials, and I'm going to base some of the assumptions I make based on what they had to say. And if you see some of the previous videos I made about a year and 2 years ago, if you see technology companies, I've done a lot of videos with them, and you can see for yourself how well they analyze things. Like they've done analysis on Palo Alto, Palantir, Qualcomm, and so on. Make sure to check those videos out if you want to understand the underlying technology that is powering these companies. So let's get into the analysis of today. First, we start making some assumptions by estimating the weighted average cost of capital that we will use to discount the future cash flows. So here we have I've taken as a reference the interest rate swap on the US dollar for 10 years, and it is around 4% as of now. And I've taken the risk premium, I've taken it from Aswath Damodaran's spreadsheets, and for this year, the US risk premium has been 4.6%, and I think it's a pretty good reference despite the risk that CrowdStrike is going to face as of now. Then we have the interest rate swap again, and the spread that we'll see probably going forward. CrowdStrike, given its risk, will have to pay more in spread, but yeah, we'll see how it develops. And the result of this comes closely around 11%, and yeah, we can see how the debt to capital composition is and how it affects the weighted average cost of capital. And then I've decreased the cost of capital going forward, given that it's everybody thinks that the rates will probably go down from now on. So yeah, I've taken that into account. Then we have some historical data that we have as a reference to understand what has happened since CrowdStrike got listed on the stock market. So we see the trajectory that until this time has done phenomenally well. Revenue growth, earnings growth from negative to very much in the positive. And then we have the free cash flow that has grown quite a lot. It hasn't translated into earnings yet because probably research and development, it's very difficult to develop all the products that CrowdStrike makes. So then we have the assumptions, and as the article from the guys from CRWD said, they said that they weren't expecting a fallout in the next quarters directly, because of the subscriptions that were already made, and given that these products are pretty expensive, they're probably not going to cancel their subscription overnight. But as the contracts come due, probably customers will either change the provider or renegotiate the cost of the service that CrowdStrike offers. So it will lead probably to a decrease in free cash flows and decreasing margins and so on, and contracting power. So yeah, so I try to take into account this fact. In the article, they were talking about a decrease in free cash flows that could be up to 20%. So this is a so this could affect the short-term years to come, and then probably I think CrowdStrike could bounce back, but it will probably affect the short term and somehow probably the medium term, and we'll see how that affects, how that translates into the price target for the share. So yeah, here we have the short term. We expect, as they said, no important event in the quarters to come, and then probably they will lose customers, or they will have customers renegotiating the cost of their service. So that takes into account the quarters until the end of the year, and then the few years to come. Then I've accounted for a bounce back, and then a long-term perpetual growth of around 3.2%. I've made it a little bit higher than usual. In corporate finance lessons, they'll tell you to use as a maximum around the GDP growth. But yeah, I think that these technology companies are more and more pivotal, so I've accounted for that, given a slightly bigger growth than what I would usually do. So yeah, these are the estimates that I've made in order to make a valuation. Then we lead into the terminal value. This is a calculation for the terminal value, and then here we have the net debt position, that at the time of this recording, the trailing 12 months, according to Seeking Alpha, it was positive. It was a net positive position. And then we have outstanding options, the options that were given out to the management as a bonus, and those were already issued, and they had a weighted average exercise price of $9.37 according to the latest 10K I could find. And here's the estimation of the value of options. This is not with the Black-Scholes model, just for simplistic reasons. But yeah, you have to remember, probably this figure is a little bit undervalued, but yeah, options tend to be exercised way before the expiration price. So yeah, probably halfway between what will come out as a result of the Black-Scholes model if we take the whole duration, and this figure over here. So then we have the restricted and performance stock units. They were around almost 11 million, and I've multiplied the current share price by the number of outstanding restricted and performance stock units, and I've subtracted all of that to come up with the estimation of the value of equity, and then I divided by the outstanding shares. They are around 243 million outstanding shares, and we come up with the the estimation of the share value. And if we take into account, as a matter of fact, in the article they said, don't rush into buying CrowdStrike thinking that it's cheap, because if what they said will realize in the coming years, it will affect a lot the share price, and probably it wouldn't make sense. It wouldn't make it a bargain. As a matter of fact, it would still make it probably a sell as of now. So yeah, don't rush into buying because of the short-term turmoil. It will probably have some effects in the long run. So yeah, these are the assumptions if what they say actually happens. What if the decrease in free cash flow sticks into the tens and not in the 20% year over year for the next few years? This would be the result. A lot better, but still it wouldn't make it nearly as close as the current share price. And what if, let's say, it were to grow at 30 and bounce back more? We would still see that it's not quite there. So yeah, we have to take that into account. It wouldn't still make it a bargain. It would still be down like 10% compared to the current share price, so it wouldn't still make it a bargain. So yeah, you have to be careful. There are sayings like, don't try to catch a knife falling, you might get cut. And yeah, probably we will have to see how the situation develops in the next year or so. Probably just looking at the next quarter could be misleading. So yeah, and by the way, maybe we could make some changes to the weighted average cost of capital. What if it were to go down? Even though I would prefer to stay conservative as of now, even with lower rates, wouldn't still make it a bargain, even if we take a pretty good scenario after what has happened. Yeah, so, and this figure was still considering the growth as if the breach didn't happen, so a 30% year over year, maybe we'll make it lower. We would still see that we're not quite there. So yeah, if I were you, I wouldn't rush into buying the stock as of now. So be careful. And yeah, so as I said before, if you want to know the technicalities of what has happened, and if you want to know more about cybersecurity stocks, I recommend you to follow the Convequity guys. I'm not getting paid to say that. I just really think they do a great job. So yeah, you will find everything in the description. So this is it for today. I'm Giacomo. Make sure to like, subscribe, and comment with the next stocks you would like to see me analyze. And until next time, yeah, stick to my videos, subscribe, and have a good day.